Monopoly Money, The State as a Price Setter by Pavlina Tcherneva. Modern System, the integration of the banking system and the state. Today, we settle tax liabilities by writing a check on our account at the bank. That check is bank money. Thus, implications of a banking system that can provide money to the private sector through credit creation must be addressed head-on. It will be shown that regardless of the process of credit expansion, the government remains the money monopolist. We will first describe how the Fed and the Treasury supply currency to the population by financing government expenditures. Secondly, we will incorporate the banking sector to show that it cannot provide currency independently from the government. Credit creation in conjunction with taxation imposed by the government does not alter the fundamental role of the state as described thus far. The ability of the government to spend is unlimited. The Treasury can have all the expenditures it desires without any constraints from the private sector. That is a reflection of its single supplier monopoly status. Government expenditure is an income to the private sector. To incorporate the banking sector, let the government engage in capital asset acquisition. To suppose it wants to upgrade the computer network of the Federal Reserve and purchases computers and software from IBM for the amount of $100 million. We will discuss what happens if 1. The $100 million expenditure is less than the population's tax obligations, and 2. It is in excess of the tax obligation. The money involved in the transaction is deposited in the banking system. The bank account of IBM is credited with reserves. The government has provided for the creation of deposits. Since loans create deposits, banks can increase the amount of money circulating in the system by making loans. Banks use a portion of these deposits to lend to other agents in the private sector. They also maintain a reserve requirement for each deposit. If IBM leaves the $100 million in its bank account, that bank has excess reserves, which it will attempt to lend to other banks in the interbank market. If the bank merely makes a loan to another customer and the money stays in the bank, but this time in the other customer's account, the bank will still be looking to hit a bid in the interbank market. Any expenditure made by the government creates deposits. Any payment of taxes reduces them. Suppose the government taxes more than $100 million. The population has to draw more money than they have initially deposited from the sale of goods and services to the government. The banking sector as a whole will not be able to meet its required reserve ratio, as required reserves are determined after the deposits are recorded. In this case, two things can happen. Either banks will fail, or, more likely, will turn to the central bank, the lender of last resort, for the funds. As the population pays its taxes by writing checks to the Treasury, it draws more money from the banking sector than the available bank reserves. How can this happen? The central bank clears interbank checks even if a bank does not have sufficient clearing reserve balances. A shortage of reserves in the system can be alleviated only by the central bank through the purchase of securities, for example. This purchase of securities is needed to keep the system in balance. The central bank is the monopoly supplier of reserves in a system where the government is the monopoly supplier of securities. Therefore, should the state impose a higher tax liability than the deposit it has initially created, the government will quickly find itself in the position of providing the funds before they are taxed out of the public. In effect, even if bank money is accepted for settling the tax obligation, It is ultimately the government, the Federal Reserve and the Treasury as its agents, that provides the currency, dollars. By accepting bank money, the state is de facto agreeing to advance credit, currency needed to discharge tax liability, to banks. In order to ensure that it will get value for this credit, the state demands collateral for loans in the form of bank capital or net worth. If there is a shortage, even though the central bank must add reserves through lending, the central bank still sets the terms of that loan. One of the terms is the interest rate. In addition, the Fed demands collateral for the loan in the form of actual securities or the bank's net capital. Thus, the Federal Reserve maintains strict capital surveillance of member banks. Otherwise, if the Fed had no capital or collateral requirements and made unlimited unsecured loans, the state would indeed lose its supplier monopoly status, and the value of the currency would be at risk of immediate hyperinflation. In sum, the state purchases goods and services by paying with its own currency. Thus, the government has provided for the creation of deposits. Any tax receipt results in depletion of reserves. Only the state has the power to determine the tax level. It is the only institution that can create and/or destroy reserves. Regardless of the multiplier process, the state is the money monopolist of what it demands for payment of taxes. We now consider the second scenario. Assume that from the inception of the currency, the system is in balance. In this case, however, the government decides to run a deficit. That is, expenditures are greater than taxation. Using our previous example, suppose that the transfer of money from the Treasury account at the Fed to IBM's account at Nations Bank, for example, is in excess of taxation. The system is flooded with excess reserves. In an attempt to earn interest on those excess reserves, Nations Bank lends to other banks. Since all banks have an account at the Fed, the reserves only get passed from bank to bank, as the Fed transfers funds from one account to another. The aggregate level of reserves, however, does not change. If there is no counteraction that drains reserves from the system as a whole, the overnight interest rate will naturally fall down to zero. Let banks extend loans to firms or households in an attempt to get around the falling interest rate. These loans are deposited at other banks, and the banking system is in check as the new deposits account for the new loans. That, however, still does not change the amount of money banks have in reserve on deposits with the Fed. The banking system is still flooded with reserves, and the interest rate keeps falling down to zero. It is the interest rate, not reserves, that is the only factor under the direct control of the Federal Reserve. To support the overnight rate, the Fed steps in and drains those excess reserves. To support the overnight rate, the Fed steps in and drains those excess reserves through the sale of government securities. As Warren Mosler points out, quote, if the Fed wire transfers extra money to the banks because the Treasury wants to spend it, all else equal, the banks don't need it. So the Fed sells securities, so there is someplace to earn interest on that money. End quote. Mosler, 1994. The same applies to the Treasury. When it sells Treasury securities, it also drains reserves. If, however, the Treasury sells securities to the private sector and does not spend, shortage of reserves results, and the Fed has to offset again. The central bank buys securities from the private sector and supplies enough excess reserves. Similarly, if the Treasury taxes the population and does not spend the dollars first, the Federal Reserve buys securities first and then provides the dollars to the public for tax payment. To recapitulate, 1. From inception, the government cannot collect more money in taxes than it's spent. Expenditure comes first. 2. Any sale or purchase of securities is done only to provide an interest-bearing alternative to non-interest-bearing reserve accounts. These are transactions that support the overnight interest rate and do not finance government spending. The government, consolidating the Treasury and Federal Reserve, has unlimited dollars at its disposal.